Good morning, Jags. This is Fahad. Today is Monday, September 21st. Let's get started. A lot of things are moving in pre-market, particularly driven by the news out of Europe related to the banking sector, which is really hammering a whole bunch of bank stocks in Europe, and that's having a massive spillover effect here in the United States. So that's what's leading down. The S&P futures are currently down by about 57 points. NASDAQ down 175 points, and Dow futures down nearly 600 points. So this is going to be a very, very ugly open across the board. And even if we were to basically go by the notion of what's happening in the Russell 2000, which is the small and the mid cap space that has been outperforming lately throughout in the month of September because of reopenings, well, that index is also getting beaten up this morning. It's down 2.2%, going to open down by about 35 points right now, if we're looking at it. So, and then that's not the only one. Gold is down $26. Crude oil is down 2.5%. Bitcoin is down 2.85%. And VIX is going to open up by more than 16% to above 30 levels. So it's across the board. Across the board, we are seeing selling, and treasuries are not providing much of a help either because treasuries are largely flat. So basically, the way I'm reading the pre-market price action on the bullish side, at least at the opening, you're not going to be able to find a lot of discrepancies where to basically look for anything that's popping. That's going to basically provide an outperformance with red everywhere, right? So everything is down. All asset classes are basically getting absolutely annihilated. Now, with that said, I do want to bring up at least technical view and some fundamental color on two stocks that are of interest over here, where I believe the news flow this morning is good enough that we could see potential breakouts in these two names, especially if the market starts to bottom out in early part in the first half hour to 1 hour of the session, and we start to see some green shoots emerge. The first one is AXSM Therapeutics. Does not need an introduction. This is a former Jaguar top pick from the fourth quarter of 2019. Has been an impeccable stock, big performer for lots of client portfolios for a long time. And Avo has come out repeatedly endorsing a bull case. Last week, we saw a big spike in this stock on very heavy volume. That was on September 14. And it was driven by the news that the company provided statistically significant data, which was well above the street expectation. Specifically, I'll just read this real quickly. The key drug for the company is the AXSM, which demonstrated a highly statistically significant reduction in patient-reported depressive symptoms compared to placebo at week 6, with median reductions from baseline, total score of 7.8 points for AXSM and 5.4 points for placebo, so significantly better than placebo, representing 48% and 34% reductions from the baseline. Now, this company also reported that it's rapidly and durably improved patient-reported depressive symptoms as compared to placebo. And there's far more details into this entire report, so I don't want to go into the nitty-gritty details of it. But this stock, because of this news last week, held up very, very strong after a high volume spike. Well, this morning, the news is that the FDA is adding AXS12, which is a completely different drug for the treatment of narcolepsy as a breakthrough designation. So this company this AXS12 drug is in planned phase 3 trial right now, and is expected to announce. It's expected to initiate the trial actually pretty soon, and then potentially announce the results in the first quarter of 2021. And then AXS05, which is completely different one for depressive disorders, that's has a significant improvement that was announced last week. So combine the entire picture together for all the key drugs that the company has pipelines. This is performing very well. Let's see if this leads to a breakout from this tight bull flag. above $84 per share. I think this can quickly run towards 90. And if it has the power and if it takes out $90 per share, then I think we're going to be looking at a new 52-week high in this name rather pretty soon. Nice consolidation and very good picture that emerged last week. Another way of technically looking at it is simply draw the trend resistance, and you can see this high volume spike that happened last week and a breakout through that. So there's that. This is AXSM. Next one that's on my watch list is Raytheon, RTX. In case if you guys did not see the news that was covered in First Street this morning, Goldman Sachs is upgrading this stock today from buy to conviction buy. Now, if you go to RTX option chain, we have covered this multiple times. You will see a tremendous amount of upside call accumulation in this name, particularly in the month of November. In all of this call open interest, this is all recorded in activity tracker, but then you have to go further out to January and you'll see 11,000 open interest in the January 65 calls, February 65 and February 75 calls. There was a large bullish risk reversal that was bought here. These February 50 puts were sold to open to finance these upside calls in February, and then go further out to June 2021, all the way out to 80 strike calls, and there's 13,000 open interest here, and that was accumulated a while back as well. So this, in the last 3 to 4 months, has seen tremendous amount of upside, short-term and long-term, well into 2021 months call accumulation. And this stock is going to gap down by about 1% despite Goldman Sachs upgrading it to conviction buy. Why? Because market is getting beaten up. But this is exactly why I want to see if it's going to make a red to green reversal when the market opens. And if it does, and if you can catch that move, particularly trading short-term weekly call options as it makes the red to green reversal, then I think there could be a lot of money to be made trading short-term weeklies. Also, I pointed out last week that the entire group is setting up very nicely. So if you look at Lockheed Martin had a huge volume rally yesterday. I think though it was driven by the quadruple witching, but it's still this is still a setup, Lockheed Martin, for a breakout through $400 per share. Then you look at Northrop Grumman. This is still a technical setup for a breakout through $350 per share. KTOS, Kratos Defense, it did break out last week on heavy volume through $20 resistance. And I think that Raytheon, now catching this Goldman Sachs upgrade to conviction buy, could start to run. So watch the price action. I don't think now you're going to see significant downside in this one, despite market getting beaten up. And if we see any stabilization, I expect to see a red to green reversal and then a rally from this point on for a couple weeks in Raytheon. And that's it for me. Jay?
Morning, Bod. So this morning I want to take a look at the packaging coatings industry. Now this is most certainly a longer term outlook. According to BMO Capital, this is a $3 billion industry that is highly consolidated, with 3 major players holding 65 to 70% of the global market share. Number 1 is Sherwin-Williams, symbol SHW. They hold a position at around 30%, followed by PPG Industries, PPG is the symbol, at 20%, and then Asco Nobel at 17%. Now, if you break this down even more, consolidation is even higher in the beverage and food can coatings, where the top 3 players hold 80 to 90% market share. Now, in a screenshot that I have for you, let me just quickly have you bring that up.
PKG chart actually looks pretty nice. I don't know if you have this on your list or not, but I'm looking at this weekly and even the long-term weekly. This is starting to turn, basically.
I did not, but there was a screenshot that I had. I think I sent it to you in our internal chat. Ultimately, BMO, first of all, they provide a couple of examples of where coatings are applied to on both food and beverage cans. And then the other screenshot is the can capacity. Over the next 18 months, a meaningful amount of beverage can capacity is coming online. Now, a review of these announced capacity adds show over 13 billion cans coming online, with additional capacity not yet formally identified or quantified yet. And this is happening over a $220 billion base in non-Asian China markets. Now, looking at Sherwin-Williams, their packaging business, which came in with the Valspar transaction a couple years ago, it sits in the performance coating segment and has 750 million to $1 billion of sales, which represents 15 to 20% of the total performance coating segment. This business is focused on metal packaging for both food and beverage cans, but they are levered more toward the beverage can side of things. So BMO believes it is well positioned to benefit from the capacity growth shown in that screenshot, which also explains its own recent capacity expansion. And then the last thing is PPG, since they are a top market share performer, their metal packaging business also caters to food and beverage cans, but unlike Sherwin-Williams, they're more levered to the food and personal care markets.
Who
So like I
would
said, yeah,
which one would your be go-to stock if you were playing this sector?
it would be Sherwin-Williams,
Yeah. Okay.
because they
And
are
then
also catering to, the home sector as well. And then if you see any a turnaround or momentum in the auto refinish business, I know
yeah.
PPG also has some exposure there as well. But I like Sherwin-Williams too for the home sector as well.
Yeah, it's got a big coating business, Sherwin-Williams that is. So, highly cyclical, but we are seeing cyclical improvements right now everywhere, particularly in the manufacturing sector. So that benefits the stock. There's also been a lot of rumors, eminent rumors in this space. I think Ball Corp has been in previous conversations where randomly it has popped on screens with traders talking about potential M&A. CCK has been involved in this previously. I wonder if Sherwin-Williams will be involved in any of those in the future. But interesting take and a very nice and steady and strong chart on Sherwin-Williams with the coating business doing well. Got to keep an eye on this. I'll add it to my watch list today. Good stuff. Thanks, Jay. Chronicle.
Morning. So Needham was out with takeaways from a presentation hosted by Gartner, which outlined the scale and opportunities for low-code application platforms. This was a 7-page report, but if I were to summarize the findings, Gartner is seeing customers accelerate their usage of low-code applications, and they expect 66% of all applications will be developed by low-code applications in the future. Like they're saying the number of vendors within the space has grown just under 100% in the past year. And in a survey conducted of 5,000 employees across multiple industries, 41% of respondents were noted to be business technologists, which is the subset most likely to turn to low-code solutions for system support and improved runtime practices. So if we look at this pyramid diagram below, Gartner is saying that increased adoption that they're seeing in low-code platforms is consistent with how these applications have evolved to address a greater portion of the pyramid of enterprise-grade software, specifically from just work groups initially to departmental and enterprise-grade now. So right now, going back to Needham's note, based on Gartner's commentary, the analysts believe that the accelerating demand for low-code platforms should support growth most directly for PEGA systems, symbol PEGA, Appian, symbol APPN, and ServiceNow, symbol NOW. These three serve mainly enterprise customers with minimal small business exposure. Personally, I don't like Appian currently because they reported sharply decelerating numbers in the last quarter, just 2% growth despite the supposed pandemic-driven adoption. And the guidance they provided for Q3 implies revenue growth to slow to roughly 7% year over year, despite management saying they're seeing shorter sales cycles and more new wins. Plus, they're also guiding for deceleration in cloud revenue. So for me, Appian is a bit iffy. Something's not right there. And I would prefer either PEGA Systems and ServiceNow. These two have also reported slight decelerations from peak pandemic numbers, but it's nowhere near as worrying as the deceleration Appian is seeing. However, there is some concern with tech stocks seeing weakness over the past couple of weeks. And between those two, PEGA Systems is the cheaper option at roughly 8.5 times forward sales, while ServiceNow is trading at 18 times. But in terms of relative performance, both have been neck and neck. I don't have a position in either right now because I want to see some stabilization in tech stocks first. Otherwise, it's kind of like going against the current. So I'm putting them on the watch list because what Gartner is saying is essentially a long-term growth case on business and system support trends. Like by 2024, low-code application development will be responsible for over 65% of application development activity. It was roughly 30% at the end of 2019.
Great presentation there, Chronicle. So I just want to point out that when I hear the discussion that your focus on these two stocks, ServiceNow and PEGA Systems, is entirely based on the IT survey from Gartner that suggests that we're going to continue to see hyper growth or really strong, solid growth in the future in the low coding business. This reminds me of a topic called AXSM from the second quarter of 2019, in which this stock performed remarkably well at the time, but also within the last 2 quarters or so, it has not done so well. It has come down quite a bit. So maybe it's worth another look at this particular time if that background that you just provided is actually true, and it speaks for the underlying structural as well as secular improvements in this name, because this has come in quite a bit in SaaS Group. When I wrote this article for AXSM, and there's complete details about this, the number one reason for this was think of no coding and no structured workflow to analyze large quantities of data. Basically, AXSM has a very simple yet powerful software which allows you to analyze and bifurcate raw data in any way for decision making without having to get hands dirty with tons and tons of coding, and without having to create a lot of structured workflow. And for this reason, this has been a very popular name for a lot of enterprise customers, although it has not performed well in the last couple quarters, having fallen a cliff sharply because of a small and medium-sized businesses and some IT budget cuts. But maybe this is worth another look at this point, especially with the Gartner survey that you just shared. Just wanted to point this out. All right, good stuff. Avo?
I don't have anything new that we haven't talked about recently. What I did see though on Friday was a opening bullish seller of 7,400 October 80 puts. Oh, the ticker is Hilton, HLT, which you discussed last Tuesday at Marriott in Hilton.
Yeah.
And now this is about, I guess with today's price, about 8% below current price with earnings late October. So I was just looking around to see if there's anything new. There's really not much new development. The RevPAR numbers had continued to improve into Labor Day weekend, which normally after that they do slow down because there's less travel. Traditionally this is back to school time, and even though this year people are more at home or still at home in some places, it's still back to school, so there's less travel. Hilton is has one of the lower closed hotels in their chain. By that metric, I think they have only 4% of their locations that are still closed. Otherwise, I don't have anything to add. Monday, let's see how the week develops.
Sometimes the futures are now down 600 points, NASDAQ down 172, down, so I mean, across the board we have red tapes. So sometimes on a Monday like this, you just want to sit back and let things settle out first in the first hour before you start calling shots. And that might be the best thing to do this morning. But to your point about RevPAR, and I know I'm just trying to, distantly make a connection over here, but what are the chances that by the time Thanksgiving is here, we're going to start to see this total travel throughput from TSA start to reach well above 1 million and start to maintain that run rate, 1.2, 1.3 million, maybe even as high as on Christmas holiday time, 1.5 million, right? And so optically, this just continues to improve. I know it's been slow improvement, but it continues to improve. Now, the risk here is naturally, and this speaks to for hotels also, you've all seen new rising infection rate in Europe. And so that's the negative part. This was worrying me a little bit last week because we currently have an open position in Marriott. We own LEAP call options, but then we saw this stock pull back sharply after going as high as 108. And then I saw news suddenly started to come out that Germany, France, UK, Spain, many of these countries are all of a sudden showing highest infection rate, going all the way back to April month. And so, and then this sector started to sell off on those concerns. So that would be my short-term concern. But aside from that, I think that the data is there to support the argument that these stocks are too cheap. But I just hope that the infection rate doesn't come back materially. Otherwise, we have a second wave problem and a whole new way to look at many different stocks and sectors. All right, we'll keep an eye, continue to keep an eye on all of this lodging stock. All right, folks, let's stop over here. Thank you very much. We'll see you in the chat room shortly.